Howdy, Jacob here. Today we're looking at Aspen Technology company in the software industry, 13.8 billion market cap on 13.6 billion enterprise value. They provide industrial software that focuses on helping customers in asset-intensive industries. Okay, interesting. Looks like they've been around since 1981. That's a pretty old company. Growth has been very impressive. Not sure what's happening with this 2022 figure, but we're looking at very good growth, almost tripling from 10 years ago. So very impressive. Operating side, gross margin side, 90% gross margin. Operating side, 30 to 40, 50% even. Very impressive with great production earnings per share and immense return on invested capital. They get a huge return on the money invested in the business. Balance sheet shows 241 million cash on hand with zero short-term debt, zero long-term debt. Only interest-bearing debt is this capital lease, and so we're feeling very good about the balance sheet. That's not going to be a concern likely for the business. And capital expenditures are crazy low. It takes nothing to keep the business open, which is very impressive. Obviously, capital intensive businesses are not necessarily bad investments, but can be tough to um, create business off of due to the fact that you have to invest so much just to keep the business rolling, like railways and stuff. But this type of business in the software industry, holy smokes, is impressive. Production cash flow, cash from operation of almost 300 million, and their capital expenditures are 7 million just to keep the doors open. Essentially, you're looking at $7 million. That's wildly impressive. Their use of free cash flow is a little bit on the acquisition side, with maybe 20% of your free cash flow. A good production, a good amount of it goes to share repurchases, and it's definitely enough to offset more than offset stock-based compensation, and then recently paying down debt. So for this company, with the great return on invested capital they have, I want them to be reinvesting in every possible ability that they have to get the type of returns such as 30, 40%. So let's start making some assumptions here. I think that on the revenue growth side, I probably would be feeling pretty fine with maybe 7%. Let's do 18 on the PE, price free cash flow. I do think they deserve a premium above the market, both on a little bit on growth. I think their growth at the end of 7 years will probably still be higher than the market, but that return on invested capital, ability to get an immense return on money reinvested into the business, gives them a huge advantage here. And I think I'm good with a little bit of a range here. And then for share changes, 1% would be about 140 million. So 140 million, 1%, offset stock-based compensation, 200 million. I probably feel good about just 1% repurchase rate. The dividend, they pay a dividend? Okay, 0.96%. I don't know why that's not showing up here. I'll just keep it how it is. It's kind of confusing why it's not showing up here, but let's just keep that dividend the same. No worries. 1% share repurchase should be fine. And given that, we still are thinking the stock price needs to fall 61% to get to the return we're looking for here. So, I mean, it is a great company. I think the numbers definitely show that. The margins are crazy, return on invested capital crazy, growth rate above the market likely. But to me, right now, I just don't think it's quite selling at a price that is so obviously cheap. I want to dig it deeper into it. But definitely one that you should put on your list to look at, do a deeper dive on, see if it makes sense to you, and definitely if it's not, keep it in your back pocket for when it does get to a price that does look attractive. So hopefully you enjoy the video. Have a great day.